All right, hello and welcome to our discussion on monetary policy. I'd like to thank Eagle 982 for joining us and sharing his perspective. And I'd like to thank also the Discord server for hosting this debate and the viewers at home for paying attention. So I'm going to start with what is money? Where does it come from? I think it's a very important topic, and it has direct relation to monetary policy. So money arises organically in the marketplace as a means of escaping the double coincidence of wants. You would produce something and you would just barter it with somebody else. You would trade what you have for what they have, but that's not very feasible for a large scale economy because you need to, if you have a good, you need to find somebody that has something you want and somebody that wants what you have. So what happens is, whatever the most desired commodity in the economy is, that becomes money. So instead of trying to barter your goods, you would just sell it for this commodity, which could be anything. For example, in Virginia, during the colonial times, they used tobacco as money, and there's been a lot of different types of monies. Famously, in World War II prison camps, cigarettes were used as money because they didn't have any currency, any bills. And a lot of different things have been used as money, but usually gold and silver won out because they have a number of money-ish qualities. They've got a high value to weight ratio, they're easily divisible. They're not very malleable, or they're malleable. They don't degrade, etc. They make good money, so that's usually why gold and silver would become money organically in the marketplace. So, paper fiat currency really got started in the 18th century. There was some paper money used in China before that, but otherwise it was pretty much gold and silver. Was the dominant money in Europe, and then on in the colonies, and they started using paper money, and that's where monetary policy starts to come from, handling this paper money. And of course, we were on the gold standard for a long time, and then during the 20th century, well, as well as the 19th, moved towards fiat money and paper money, which is what we have now, which is money that's not backed by anything. So now let me just give a brief overview of monetary policy. The ideal monetary policy, I think, is to go back to a gold standard where all the money's backed by gold. At any time, you can trade in your money and have it redeemed by gold. And so the advantage there would be that the money supply is fixed. So it's not inflationary. Prices wouldn't be going up every year. You'd have a little steady deflation. And this would greatly constrain government spending and imperialism and war, because war is extremely expensive and requires not only the ability to collect taxes, but also the ability to debase the money supply. So that's basically an overview of my position. Would you like to discuss your views, Eagle?
Sure. So, I mean, if we're talking about, the foundations of money, I mean, a lot of the stuff, the history you talked about, I agree with. Earlier societies, things like, commodity money and money as, people using pelts or salt or tobacco as money, in the past is all very interesting. And then, of course, you bring it around to gold. And so under your system, just so I'm clear, I mean, we'd have dollars, exchangeable for gold, right? Is that the idea, backed by a set amount of gold?
Yeah, gold, possibly some other commodity or precious money. I mean, my ideal system is simply competing currencies, but I'm also highly interested in a gold standard as sort of, I guess, a close second. But yeah, you could redeem your money at a fixed rate for gold. Yes.
Yeah, and so in general, I'm not I'm not a macroeconomist, and so generally speaking, throughout this discussion, I'm probably just, as I mentioned, I'm probably just going to discuss the mainstream view. And so, the mainstream view in economics of the problem with gold is there's a few problems. So one problem, and I'm sure you're familiar with this, is the deflationary nature of something like a fixed supply of gold backing up the currency. So, each dollar eventually becomes worth more, and then the problem is that with that is you have I guess a couple issues could arise from the deflationary nature of a dollar becoming worth more in a literal sense. This could cause a problem with people who have taken loans, in theory, in a deflationary economy. Payments on a loan could become, essentially more and more money over time. Another problem could potentially be that, if we expect deflation, then people, wait on purchases just naturally, which will, potentially cause some kind of economic problems in that, people are waiting to spend money because they expect the price to go down, and, price falls, in a way that's very bad for economic activity because people are waiting to spend their money. So these are some of the immediate, mainstream issues that a lot of economists have with gold. And then the other is, something that you're going to see as a feature, not a bug, which is, we see it as kind of a bug, which is that, lack of fiat money means that, you can't have any kind of control over the money supply. And so, most economists, in general, the mainstream view seems to be that the right amount of inflation is around, 2 or 3%. And that's something we can try to target through monetary policy. We can do different kinds of things, inflation targeting, nominal GDP targeting, different kinds of tools. And the tools that the central bank has in a gold standard economy may be severely limited, which could limit the ability to, close output gaps, for example. So that's kind of my understanding of the mainstream objection to the gold standard.
Yeah, great. So in terms of deflation, I agree. I think it's self-evident there would be some deflation. But I don't see that as a harmful thing. I think that, well, first of all, I don't think that the velocity of money theory is correct. That the economy is driven by spending, but rather by production. So if people saving their money, right? If they did choose to put off purchases and save instead, I don't think that's a bad thing either. I think that long-term economic growth is based on savings. What happens is people save up, and then that money gets invested, and that constitutes new capital. That's how capital accumulation goes about. That's how standards of living and rise and production increases. So I don't think that consumption drives the economy. I don't think people spending money drives the economy. I think that production drives the economy, and it doesn't really matter if people are saving. That's not a bad thing. It's just a choice that people make, and it's not a bad thing if people consume either. That's their individual choice, and they have to make whatever they think is going to lead to the best utility. But in terms of savings harming the economy, I don't think that's the case. I think that it's just a greater supply of loanable funds available for entrepreneurs.
So for me, it's hard to differentiate this whole thing about production versus consumption, because I know in the old school Keynesian view, which is, for the record, not the mainstream anymore, right? You probably are aware that aspects of real business cycle theory and aspects of post-World War II Keynesianism kind of make up, the new neoclassical synthesis, so to speak. It's kind of a combining of real business cycle and neoclassical and like some later Keynesian stuff. But like, I know there's this kind of old school Keynesian focus on consumption. And then, I know that the Austrian perspective is to focus more so on, I guess, production. It's not obvious to me that one or the other, is really the key driver here, right? Because obviously, stuff is what, the economy is made of stuff, and stuff being produced is how we have an economy. But at the same time, I mean, why is money being saved? Why is it being invested in capital? I mean, isn't it being invested, like money being invested in capital, or money going into savings accounts and then being loaned to people to make investments? I mean, these are things that, ultimately come back around to consumption, right? I mean, when you don't spend money and it goes in a savings account and that increases the supply of loanable funds, now somebody can more easily borrow money to do what? Don't they do it to demand things? Don't they borrow that money to consume something? So why the strict focus on production?
Yeah, so some people definitely value consumption. Other people value consumption later, or even value consumption past when they die in terms of savings and giving money to their children and whatnot. So people have different time preferences and different values, and that definitely impacts. I agree that the purpose of production is consumption. That's why we produce, right? So that we can have ultimately a higher standard of living. I mean, there's really no point in putting off consumption, until past you're dead. I mean, at least from my perspective, I guess somebody who really cares about their children, they will want to do that. Maybe I will someday, hopefully, I guess. But for me, I mean, you make money, you produce something so that you can consume it either now or down the road. Absolutely. Now, I wanted to touch on what you said about modern monetary policy, the neoclassical synthesis, and Keynesian theories, because it seems to me that Keynesianism is still pretty dominant in the analysis. I mean, at least in the media and in what the central banks are saying. They're talking about the goal of full employment versus inflation, and that seems to me to be straight out of Keynes's general theory, that this paradigm of sort of the economy being like a car driving over a narrow abyss with the looming perils of inflation and unemployment on either side, and then the role of the state or the central bank to be driving the car carefully, down this rickety bridge in order to make sure you don't fall over into either abyss. But I just think that's complete nonsense. That Keynes's general theory was basically fiction. Just it does not correspond or with reality at all. And I think that the Keynesian myth is still very much dominant in discussions of monetary policy. What is your take on that?
Well, there's certain aspects of Keynesianism that that the general mainstream seems to accept. And so, something like, for example, a big part of like early Keynesianism were these output gaps, which is the difference between, potential GDP and actual GDP. And in the new mainstream view, they really, so first off, so one change they make. So yeah, the changes are a bit more nuanced because obviously, like, if you're coming from a perspective of the way people talk about the role of government, as opposed to a laissez-faire approach, I can see how that might come off as Keynesian. But it seems to me that basically the modern consensus when it comes to monetary policy is that, to put it really simply, like a very simple view, is that Keynesianism in the short run, monetarism in, well, neoclassical economics in the long run, maybe, would be a better way to think about it. Which is that, essentially, that money is not neutral in the short run, but that money is neutral in the long run. That seems to be the mainstream consensus. And I know that my understanding is that Keynes would have viewed money as never being neutral, which is interesting because I believe the Austrians view it that way as well. But yeah, I mean, for me, it's that, the myth, did you say something about the myth of Keynesianism, or how'd you say it?
I forget my exact wording.
So for me, it's, mainly, I think that a lot of these discussions end up differentiating between Keynesian and non-Keynesian as being mainly about your belief in, like, how the government ought to interact with the economy. But I think that when we think about, like, and we can talk about that, but when we're talking about monetary policy, I think there are fundamental problems with the Austrian, business cycle theory that I think even a non-Keynesian neoclassical model can better handle, in my opinion.
I read somewhere that like interest rates don't have the same effect on investment like Austrians believe, unless they're very high. I look, an example would be like in the UK when they did QE, bank lending didn't increase despite low interest rates. Yeah, I mean.
Thank you for joining us, Keynes enthusiast.
Keynes enthusiast.
I just wanted to get into Austrian business cycle theory for a moment here. So, three things happened at roughly the same time, which was the advent of the Industrial Revolution, the establishment of central banking, first in the Netherlands, but then the Bank of England, not very long after, and the modern business cycle. So, the modern business cycle has been ascribed to capitalism, to modern industrial capitalism, because they started at the same time. But in reality, it was the central banking that was at fault. So what happens is you have credit expansion on behalf of the central bank, or on behalf or as a result of fractional reserve banking, and this credit inflation leads to misallocation of resources, specifically in capital goods industries, because you have artificially low interest rates brought about by the credit expansion, which would normally, in a market economy, indicate that consumer time preference had lengthened. There was a greater demand for capital goods as opposed to consumer goods. But because this is illusory, and the investments, the malinvestments, are uneconomic, they must eventually be liquidated, and then you have the recession. So I don't think that recessions are inevitable, or a byproduct of capitalism, or the animal spirits, or anything like that. But they're simply a result of creating new money, of credit expansion, and ultimately the central bank and fiat money itself are responsible.
So when you talk about the malinvestments, is this so this would be a scenario where like, a central bank lowers interest rates and this causes malinvestments among like business people? Is that the theory?
Investments that are concentrated in capital goods industries. Yes, yes.
So before we get into the specifics of the capital goods industries, because I have some thoughts on that. The big objection to this from the mainstream perspective is, I'm sure you're aware of the rational expectations theory that has basically still dominating macro in the 21st century. And so the counter argument that I'm aware of is that if the government lowers interest rates, and so the central bank lowers interest rates, don't entrepreneurs and business people have the foresight to understand that eventually interest rates will be raised? So, they're able to do, all these complicated transactions and calculations in making, decisions. I mean, especially from a Rothbardian standpoint, you're gonna defend, entrepreneurs' decision making, very strongly, and Rothbard does this. But it just seems that like the malinvestment, because they overweight short-term investments as opposed to long-term ones when interest rates go down, it just seems like they would form some kind of rational expectation to understand that rates are eventually going to go up, and that's going to affect their decision about investments, in that they're going to think the best way to say this, which is that like they're going to make investments that should be profitable in the short run, knowing that rates are eventually going to rise, and they're not going to make investments based on an expectation that interest rates are going to stay permanently low. And I think that this is something that, Robert Lucas, he won a Nobel Prize in economics in the 90s for his work on rational expectations. And so that would be like a pretty major mainstream argument against the malinvestment argument about lowering interest rates.
Yeah, well, to start with, I think
sorry if I'm being overly
I think it's the other way around. That it is, they're making the long-term investments, the capital goods industries, right? So they're investing in the production of mines as opposed to consumer goods like a toy or something, right? So it's that the money they're making the bad long-term investments that they shouldn't be making, not the short-term. And so why the cluster of errors? Why are these entrepreneurs fooled? Because, as you say, entrepreneurs are usually pretty good at forecasting consumer demand. And the reason why, the answer is because, how do entrepreneurs know where to invest in the first place? It's the price system, right? The price system is what, quote unquote, plans a market economy. If you have the supply of wheat plummets and the demand stays the same, the price goes high, and this is a signal to entrepreneurs that they can profit by planting wheat or importing wheat or whatever. So in terms of investments in capital goods industries, the price signal there is the interest rate. That's what informs entrepreneurs of whether consumers, what their time preference is, whether they want more capital goods or more consumer goods. So there's just no way to know that the price signal is wrong, or absent a price signal, you're stuck in the situation of the Soviet planner who has to allocate resources on the basis of their best judgment. It doesn't matter how good your judgment is. You can't plan an economy. You need the price system. And so, but the price system is what is being compromised by the inflationary policies of the central bank. Now, one of the goals of monetary policy, perhaps the primary goal, you might be able to shed some insight onto that, is a stable price level. Is that correct?
Mm-hmm. Yeah, that would be right. Yeah, I think so.
So this is nothing new. Central banks have been aiming for a stable price level for a long time. In fact, during the 1920s, that was an overriding policy of the central bank, the Federal Reserve, and they were pretty successful in terms of keeping the price level, at least for consumer goods, relatively stable. But this was very problematic because there was a great increase in productivity at the time, so prices should have been coming down, and in keeping the price level stable, there was some serious misallocation of resources, which ultimately culminated in the Depression. And the Depression itself shouldn't have been nearly as bad as it was, but it was greatly exacerbated by Hoover's policies of intervention to sort of fix the problem, which was then taken over and expanded upon greatly by FDR.
Well, now we're getting into a historical event that has a lot of different, interpretations. So I'm not sure, we'd have to really dig into the historical causes of the Great Depression to talk about it. I mean, I guess again, if I'm to try to think of what the mainstream view probably is, which is that, the Fed allowed the money supply to essentially collapse in the 30s, and that if it had maybe I think Milton Friedman talks about this. I think if it had been more proactive, it may have been able to prevent that problem. That's the general understanding that I'm familiar with, and that the role of the Federal Reserve has changed since then. So, after this happened, we gave the Federal Reserve the right to, we gave the Board of Governors, the right to set the discount rate. Basically, it would seem that the Great Depression, demonstrated that severe deflation, the bank system of the country falling apart. These are things that are devastating in real terms to people. They have real effects on people, and that we've developed better monetary policy since then, especially since the 1980s. So in the Great Depression, we had severe deflation. We saw the problem with that. We had high inflation in the 60s and 70s. And, since then, the mainstream monetary policy view has been to be more proactive and do more to stabilize prices. I mean, this was, a failure to stabilize prices back in the day. I think Milton Friedman said in the 60s or 70s that what the Federal Reserve should have done in the 30s is expanded the money supply, and not allowed, provided liquidity to banks or something along those lines to prevent their collapse. But as far as the historical causes of the Great Depression, I mean, that's a very complex thing. That would take, I don't know for sure what my belief even is on that, because I've heard so many conflicting things.
Yeah, it's definitely there's a lot of causal factors there. And I agree with you on Friedman's view of the Great Depression, the role of the central bank, and the failure of the Federal Reserve. His view was that the central bank didn't do enough to stabilize the banking system, to reinflate the money supply. And yeah, I mean, the Great Depression, obviously a pretty complicated event, and perhaps beyond the purview of this discussion. So I think that going back to business cycle theory, it has to have something to do with money, okay? Because money is something that touches every aspect of the economy. So if there's a systemic cycle of boom and bust that affects not just one particular industry, but every industry or the economy as a whole, then it has to have something to do with money, because that's the only thing, as I said, that touches every aspect of the economy. Now, during a recession, it's common to have deflation. Prices fall. People don't have as much money. They can't afford the old prices. And not to dwell too much on, the aftermath of the Great Depression, but one of the problems there was that prices weren't allowed to fall. Why was there such high unemployment in the 1930s? Because the price of wages wasn't allowed to fall. Anytime you have an unsold surplus, you have to ask, well, at what price, right? So FDR was very adamant that wages had to be kept up so that people could afford to buy stuff and the economy could keep going. But the consequence of that was massive unemployment, which persisted for quite some time. And if you contrast the Great Depression of 1929 with the little recession that nobody's ever heard of 1920 to 21, where instead of trying to solve the problem and create massive public works programs and stack the court and do everything else that FDR did, Harding at the time did almost nothing, and the economy righted itself right away. And then I just want one more point. I'll get back to you. I'll let you talk. But you mentioned the inflation of the 1970s, which was in fact stagflation with high unemployment and high inflation. And this was a consequence of the guns and butter of the 1960s with the Great Society and the war in Vietnam. But stagflation disproves the Keynesian paradigm of unemployment versus inflation, because there was both, right? So it really exposes the mistruth of the central bank saying, or monetary theorists saying that you have a choice between unemployment and inflation, because during the 1970s there was both.
Yeah, so this is something I know a bit more about. So this is something that Keynes got wrong, and this is something that we no longer have. Again, this is something that the new consensus, so to speak, recognizes Keynes's shortcomings on this problem. What's interesting about it, though, is that my understanding is that Rothbard seems to present Austrian business cycle theory as like the only good explanation for stagflation. And so, stagflation is definitely a problem in old Keynesianism. However, modern economics, we have plenty of non-Austrian explanations for things like stagflation. So you could have a resource shock. So maybe a bunch of there's a negative oil shock, and now prices go up and output falls. You can have again Robert Lucas, what he got the Nobel Prize for in the I guess in the 90s, I think, was rational expectations, right? So you have something that we've seen kind of recently, something that almost caused we're not in stagflation. It didn't happen here this year, but it could have because we had a scenario where workers see inflation happening, they react to it, they want to be compensated for it, and they ask for higher wages. And so now, in response to inflation, they demand higher wages, and now real wages go above the market clearing rate, and we have higher involuntary unemployment, right? Any kind of, real business cycle theory, for example. So again, an aspect of the new, mainstream macro theory that it probably pulls from real business cycle theory is that business cycles can be caused by technology shocks. So again, a technology shock, a negative technology shock, just like a negative oil shock, could raise price and reduce output. So Austrian theory has a theory for stagflation, and early Keynesianism failed to handle that, but we have theories that are just as good for that in the modern mainstream macro.
Yeah, if you look at the so-called oil shortage during the 70s, I mean, wasn't the problem there just price controls? That, like, you don't really get shortages in a market economy. The price goes up until supply meets demand, until the market, until the quantity supplied equals the quantity demanded.
Sure. So yes. So in our definition of shortage, as long as price, if right. So this doesn't have to be a shortage, just a negative oil shock. So I know Nixon used price controls. That caused misallocation of oil across the country. That was bad. But any kind of negative oil shock could cause stagflation, theoretically. I mean, imagine a scenario where, today we, I don't know, a nuclear bomb goes off in Saudi Arabia, and now, there's way less oil on the world market. I mean, that could cause, that's a natural resource shock. As far as, shortages, I mean, that's not what I was talking about, and also not, that's more like, I don't know if you'd call that legislative policy, industrial policy. I don't know. It's not quite monetary.
Right. It's regulatory policy, not monetary policy. Oh, Nietzsche.
I'm interested.
Good to see you.
Hello. Is anyone recording this?
Yeah, I'm recording. What were you going to say, Eagle?
Oh, I was going to say I'm interested in talking more about the capital goods thing because, I prepared, some of the stuff I looked into. Are you familiar with Baum-Bauer's capital theory? Is that a big thing that Rothbard pulls on in developing Austrian or in talking about Austrian?
I've never read Baum-Bauer.
Gotcha. So like in a depression, would there be isn't the argument that when there's a depression, the short run, like the move from capital goods to consumer. Oh, nice. My understanding of one of the critiques of Austrian business cycle theory is that it supposedly implies that when there's a depression, it predicts a short-term increase in output. And in other words, because of this misallocation from capital goods to consumer goods, this implies that there'd be greater production, and then afterwards, production would be lower than it would have been had capital goods been produced instead. Are you familiar with that argument at all? Does that ring a bell?
No, I think it's quite the opposite. Is that during a depression, you would have a short-term decrease in output. So the Austrian view is that the depression is actually the healthy phase of the business cycle, because what happens is the malinvestments are liquidated, and then the factors of production are realigned towards consumer demand. So during the liquidation process, production would go down because stuff's being sold and resources are being put to different uses, and there would actually be more production during the boom when the investments are first made. So yeah, I think it'd be the other way around.
So talking about the capital goods thing, so just so I can think about this more, artificially low interest rates cause misallocation from consumer goods to capital goods production. Is that correct?
Yeah. So what determines whether or not entrepreneurs direct resources to capital goods? Capital goods being, of course, capital being man-made factors of production, like factories or a hoe or whatever. Anything that people make that contributes to production is capital. More for the audience's sake than yours, Eagle. So you have this division between stuff that's made to be consumed immediately and stuff that's made to produce more. So consumer time preference meaning whether you want stuff now, in which case you have a high time preference, or whether you want stuff more in the future. So if you have a low time preference. Like an example of an ultra high time preference individual is a drug addict, okay? They want stuff now. They want to enjoy the moment. They don't really care about the future, And then at the opposite end of the scale, you've got people that just save every penny, invest, they live sort of, they're misers or whatever, or they're just saving for the future. So if interest rates go down, are artificially lowered because of credit expansion, this is the same thing as if time preferences had increased and there was a greater supply of loanable funds. So the price of interest would go down because supply and demand. There's more loanable funds versus the same demand to borrow, so the price would go down. So that's why you have the cluster of errors in the capital goods industries, because it basically mimics what would happen if consumer time preferences had changed and people had lengthened and people wanted more stuff in the aggregate later on instead of today.
So when this happens, you have the inevitable. So we have the boom, the artificial boom caused by the low interest rates, and this boom is being driven by a misallocation from consumer goods to capital goods. Then the bust comes, and oh my gosh, I haven't touched my mouse in like 20 minutes, and so my screen's turned off. I thought my computer lost power. Okay, so as I was saying, so we have this misallocation from consumer goods to capital goods because of artificially low interest rates, and then what we get is that when we have this the depression coming as a correction after the artificial bust. The problem is, I don't know if it's the case that wouldn't we see a reallocation from capital goods to consumer goods during a depression, and yet it doesn't seem like we do. And so what happens is we had this period, this boom leading up to a depression where there's artificially high demand for capital goods. And so therefore, the relative price of capital goods is higher than it would be in relation to consumer goods than it would be in a free market. So we've distorted the price signal. And therefore, consumption goods must be too cheap relatively. And so then we have this, what Rothbard calls, the reasserting of the investment preferences to undo this misalignment, or the misallocation of investments between capital and consumer goods. So you would think that this would make consumer goods industries better off, right? So what we get in Austrian business cycle theory is essentially, if you take this prediction about the realignment from capital to consumer good investment when the depression inevitably comes, we would think that employment would increase in consumer goods industries as it decreases in capital goods industries. But what we see, on the other hand, is that it seems to be the opposite. And so then what we get is this other, tangential point or transitive point from this, which is that in theory, we would see an increase in, or rather, this essentially, so something that I like about this is that it does help explain why capital goods industries suffer more. The problem is, I think we have a better explanation for it in mainstream economics, just based on our understanding of demand, which is that when we look at the business cycle and we look at how, during a depression, capital good demand falls. Well, it's not just capital good demand that falls, it's also durable consumer good demand that falls, or rather production. And so what it seems like we get is a better explanation where, because durable capital goods and durable consumer goods should be more sensitive to changes in people's income than non-durable goods like perishable food, for example, we see a much bigger decline in demand for not just capital goods, but consumer goods that last a long time, such as something like a television or a desk or something. And so what seems to be, the focus on the capital goods thing seems to be this one of the merits of the Austrian business cycle theory. And it just seems like in several other places where I think I've mentioned, it's not obvious to me that we don't have a better explanation in just like mainstream econ. Sorry if that was overly verbose. Again, if we start talking about micro foundations, I feel like I can talk a lot more lucidly. This is, you might notice I've been pausing a lot because I want to be very careful here, because macro is something that I don't have the level of expertise on as I have in micro, and so I really have to take my time.
The problem there is that the Austrian school doesn't really have any big beef with modern economics on micro, so there's just not enough room for disagreement, in my opinion.
I don't know if that's true. My understanding is that Austrians. My understanding is that Austrians don't agree about indifference. They don't use utility functions. They have some really, welfare economics, for example, is one of my specialties. And that's something that my understanding is that Rothbard rejects most of welfare economics, because he doesn't believe in anything that's divorced from action. So
what is welfare economics?
Welfare economics just has to do with understanding the amount of utility or consumer and producer surplus produced in an economy as a whole. And so the Rothbardian view, which I think is built on which was expanded on by Hoppe, I think, is that, the only thing we see is that the free market maximizes social welfare because it's made up of all kinds of voluntary exchanges. and everybody gains. And they don't, or at least Hoppe talks about how he rejects the idea of like Pareto improvements or looking at things, thinking about third parties. I think they're not crazy about any the idea of externalities outside of like concrete action taken by a third party. So I think a big part of the micro foundations of Austrian economics is that they don't believe in any kind of utility that can't be observed through a revealed preference, such as a decision to act. Right. So I think the micro foundations are the biggest because, again, I mean, as far as macro, it's like I think the big parts of Austrian business cycle theory, which is that like involuntary unemployment comes from when wages are too high, and trying to use inflation to fix that is not very useful. Other than that, we've talked about the more controversial stuff, like the malinvestment thing, which I still am not sure. And then just other stuff like, it's not, I'd have to think more about the Austrian business cycle theory and its relation to the capital versus consumer goods thing. But I'm pretty sure my understanding of, the way the Austrian business cycle works, it seems to me like you would have high unemployment, or rather it doesn't seem to offer a good explanation for why unemployment is high during the bust and low during the boom. If all we're doing is just reallocating from capital goods to consumer goods and fixing the malinvestment.
Well, the problem is that's not all we're doing, right? Yes, that would be the case if the government didn't intervene and try to keep up wages. But once the government does, that's where the high unemployment comes from. But I think that overall your analysis of Austrian business cycle theory and its predictions is correct. You're just mistaken as to what the data says. Obviously, it would take a long time to parse that and go through all the facts and figures. But I have a question about this shock theory, because like you wouldn't even have a cycle if it was caused by shocks, right? There wouldn't be this systemic recurring boom and bust unless you had shocks on a consistent basis. I guess, is that the argument? Or it seems like it's not really a cycle theory, it's an explanation of specific events.
So the shock thing was just a mainstream like in other words, the shock thing is just an explanation for stagflation. The mainstream, like, a big part of Rothbard's thing was like showing, hey, like, some of the Austrians back in the 70s pointed out that Keynes failed to, Keynesianism lost popularity in the mainstream because of its failure to deal with stagflation. That's a big part of it.
Right.
And so what I'm pointing out is that there, we in the mainstream, monetary policy sphere, we think that there are plenty of things we can do to explain stagflation that are outside the Austrian theory. The Austrian theory has an explanation for it, but it's just a simple counterexample. It's like, oh well, a negative supply shock could cause stagflation.
So do you have a positive business theory, like a general business theory, business cycle theory?
Like what causes the business cycle?
Yeah.
Yeah, it seems to just mainly have to do with, people's expectations. I mean, I think that the rational expectations idea is a pretty dominant pretty dominant force in the sphere of modern, monetary policy. Just that, people form expectations. If consumers are confident, they feel good. They have expectations about higher income in the future. They're buying. They have expectations about stock prices going up, businesses hiring workers. But then eventually, you might get an asset bubble or something like that, or maybe this causes some level of inflation. Eventually, if maybe the economy overheats and then you hit some kind of peak. This can cause, again, this is, the kind of stuff that we might see in 2008 with a housing bubble. And then eventually, you get some kind of contraction. So maybe the contraction is caused by an increase in interest rates. Maybe it's caused by inflation being too high. Maybe it's caused by a financial crisis. And then people start to panic. I guess the Austrian response to this is going to be that this would happen. This only happens, this would not happen in a purely free market. And that's an interesting thing that I have to think more about, because it's not obvious to me that we wouldn't have, a business cycle without active monetary policy manipulating the economy.
So it seems like you're saying that it's all sort of a psychic phenomenon. mass hysteria.
Animal spirits.
Hey, we're back to Keynes now.
Maybe. Yeah, I mean, it's, this is why I'm not, again, I mean, I'm not a macroeconomist. So I'm trying to think. So if we remove monetary policy from the equation, could people become overly confident in the market? Could real wages change because of change in productivity? Okay, now real wages go up because productivity has gone up. Now what? Okay, well that's, an upward, that's the expansion. What's going to cause the contraction then if we're not setting interest rates from a central bank? I guess consumers building some kind of, fear over something, bad economic news happens, right? They start to become less confident, Is the Austrian stance that there can only be a business cycle from real shocks or rather that there'd only be a business cycle from real shocks if there were no monetary or fiscal policy?
The Austrian view is that the business cycle comes from monetary policy, that absent central banking and fiat money, there wouldn't be a recurring cycle. Yes, you could still have shocks to the economy, like a plague or, negative events, but that wouldn't be a business cycle. That would just be like a war, Obviously, economic output's going to go down, but that's not like a cycle. That's just bad stuff happening.
So what if people just make poor investments in durable goods? So people start building wealth and investing their wealth in housing, and then somewhere in the economy preferences change and some kind of negative wealth effect occurs because the price of housing begins to fall. And then that causes a bit of a panic or something like, I guess the argument from the Austrians is going to be that the government caused the crash of '08. Because for me, it's like it's not obvious that the crash of '08 couldn't have still happened in a free market. It's like you have people that are borrowing from banks. They think that the price of the house is going to continue to go up. The loan is going to pay for itself. And then we get a scenario where, you know, people eventually default, you know, when the housing price falls. You know, like, why wouldn't that naturally just cause some kind of business cycle? In my mind, like, it's not obvious to me that that wouldn't cause some kind of business cycle. Like, that wouldn't cause an expansion and then a contraction over just something like housing.
I think the Austrian view, and this isn't one I'm willing to defend, by the way, but I'm just putting it out there as what I've heard other Austrians say, is that the housing bubble was caused, at least in part, by loose monetary policy in response to the tech market crash. So the central bank wanted to use easy money as a means of sort of fixing the stock market, the tech bubble, and they reinflated the housing bubble. And then you had also, I guess, regulatory problems, like people were being they were trying to get mortgages to people who couldn't necessarily afford them. And there's also the moral hazard too of the government bailing out financial institutions that make bad decisions. So you get that all coming into play. But yeah, I don't think just to get back to your question, I don't think that let's say that people make bad decisions, invest in an industry, and then there's way too much supply. I don't think that the reallocation of that supply it wouldn't matter if people panicked or whatever. It doesn't matter. The price system solves that problem. There's too much supply, the price goes down, and factors of production are put into whatever is more demanded, whatever there's a quote unquote shortage of, and it's just consumer confidence just doesn't matter is basically my opinion.
I'd be interested if you said you weren't really aware too much of the micro stuff, the differences between like Austrian and like neoclassical micro. But are you, like,
my understanding
was
that the Austrian view was, that overall, micro is in good shape and macro is just a total shit show. That's my understanding of the Austrian opinion on the differences between mainstream economics and Austrian economics. But, maybe that's outdated too. That's coming from maybe 20 or 30 years ago when that was said. So who knows the evolution in micro. Maybe there are dramatic differences in micro as it's sort of understood by economic academia today than what the Austrian school says. It could be, definitely.
My understanding is that they don't believe in indifference between two goods baskets. That's like a big part of it. So like we use indifference curves to teach micro and to build micro.
Yeah, I would say like the concept of like you can't add together utility. Utility is just ordinal. I mean, we know like that's. I don't know of any economy. Mainstream is ordinal as well. The cardinal thing is not. Nobody believes in cardinal utility. But you're talking about a basket of goods compared to another basket of goods, and there's what do you mean by indifference?
So basically, I think this is very foundational, which is that Mises and Rothbard believe that you can only determine someone's preferences through their actions. There's basically no bearing in their theory of like a preference in my head of like, oh, I'm indifferent between the green shirt and the red shirt because I can only buy one. And so even me randomly even me flipping a coin and choosing the red one to them is me revealing a preference about the red shirt. And so I think that comes from, I guess, like maybe from like the action stuff that they're really big on. And so they don't believe in indifference. That's just like a fundamental part of Austrian. And so they don't use
I really think that's a straw man.
Really? I thought isn't that like that's like a big part of Austrian theory, I thought.
No, I don't see why an individual can't consider the utility of two things to be similar. I just don't think that's an Austrian view. I'll double check that, but I don't think there's any reason. But I don't think you can have a basket of goods or a basket of like I don't think you can compare the utility of like 4 or 5 different things with 4 or 5 other things because you can't just add up utility. There's no util. You can't.
Well, it's not that we can add them up. It's that it's ordinal. It's that we can just compare. We like this basket more than the other.
Yeah, I don't think you can. So in that sense, yeah, I don't think you can compare the utility of like 5 or 6 things to the utility of 5 or 6 other things and get any sort of meaningful result. So in that sense, yeah, you can't. But you can definitely be ambivalent between wearing a red shirt and a green shirt, in my opinion. Maybe I break from the Austrian school on this. Who knows? I mean,
well, definitely. Again, I mean, I'm very confident that they do not believe in indifference because again, for them, action on something demonstrates a preference, and so. They don't believe that action can demonstrate indifference. If I buy that red shirt, I bought the red shirt, not the green one. And I think that's a pretty foundational belief to Rothbard.
And no, I don't think so.
Well.
And you could have just chosen it. No, I don't think so. I think you're incorrect.
It could be worth. I'll find.
We can pause now if you want, and we'll both go look into it. Now, that might be... We've already gone for an hour. That might be a solid place. And then we can also, we can revisit this again a couple weeks from now. We can look into what each other said. Maybe, I don't know if you want.
Yeah, I'd be interested in talking about the micro stuff if you're interested, just because, like, as I mentioned before, the macro stuff, it's hard, I don't have, like I said, I'm going to talk about my understanding of what the mainstream belief is in macro, but I don't have any like super strong beliefs about macro policy, at least at like a theoretical level.
Right.
But the micro stuff is something I have a lot of expertise in just because like, I've taught micro theory quite a bit and, walked through the micro foundations in neoclassical, price theory and whatnot.
Mm-hmm.
So yeah, we could pick up at another time.
All right, great. Well, thank you so much for participating in this discussion. Great opportunity for me to have access to a learned mind such as yourself. And thank you for joining us on this Discord server. Hopefully we can have many more discussions in the future.
Yeah, my pleasure. So, yeah, learned mind. Now you see how how big the difference is when you specialize in micro. How how much less I can say about it. It's funny. The guy who's probably the macro expert is Kevin, the other econ guy on the server.
Yeah.
But he does like bank regulation.
Well, it's like, you're in a video game. You got to take on the little boss before you take on the end boss, right? So I'm progressing my way through this RPG.
Yeah.
I think we have a better discussion, actually, because it's not your specialty. I'm not a member of academia at all. So we're on more of a level playing field, given that you're...
Agreed, because if I were a professor of macro, it would, it would not, it would be much different.
Yeah, exactly, right? It wouldn't be a fair contest. It'd be like, you got the Olympics where you got all the best non-professionals going up against Kobe Bryant, just dunking the basketball every time. You're like, well, I can't compete against that, So,
Yeah.
And as we all know, it's all about competition, choice.
Right. Yeah, of course.
All right.
I
Well, let's end it there, and we'll pick it up again at a time that's convenient for both of us, and
Cool.
we'll revisit this whether Rothbard or Austrian economics says that you can be indifferent, and possibly substantiate some of the claims that were made, and such. We'll have a little time to research, prepare.
Sounds good.
All right, peace.
All right, man. Yeah, have a good night.